All right, this is the Town of Monroe Pension Committee and OPEB Board of Trustees joint meeting, Thursday, January 26th, 6 p.m. This meeting will be recorded and made available on the town's website pursuant to state law. If you are attending remotely, please remember to mute your microphone unless you are speaking. Anyone participating remotely should state their name and title, if applicable, at the outset of each occasion that that person is speaking. All votes taken in which any member of this body are participating remotely shall be taken by roll call unless the vote is unanimous. The chat feature will not be utilized nor considered during this meeting. So we will call it to order. Quick roll call. I think I see Mike Patella there.
You're seeing things.
I'm seeing things, so he's not there. What am I saying? Who am I seeing there? Okay. I see Kirsch, Mr. Kirsch there.
Yes.
See Romanovsky.
Yeah, so I'm
Want to go through the list, Mike?
yeah, maybe.
Yeah.
So we'll do OPEB first. Mike Vitello. I don't know unless he's on. He could be one of the phone ends. Mike Vitello, you on?
I think
No. Mike Manjos is here.
Yep.
First Selectman Ken Kellogg. That would be me. I'm here. I think I'm here. Finance Director Ron Bonovsky.
I am
is
here.
Chairman of Town Council John Formicella, I know is on.
Here.
Thanks. For Pension Committee, Board of Finance, Mike Manjos is here. Steve Kirsch.
Still here.
I'm still here. Superintendent of Schools Joe Cobza.
Here.
Town Council Rep John Formicella, we know is here. Town Council Representative Jason Mauer.
Here.
Oh,
Yeah, which he was at.
okay. Jason, we had some feedback. Just confirm that you're on.
I said you're
I'm here.
Thank you. Dennis, Board of Ed Representatives, Dennis Condon.
Here.
Christy Fensor Martinez.
You know what? I'll have to see if she got the email.
Okay.
We have enough for quorum, right?
And Town Treasurer Frank Duchess.
I'm here.
Who's here? I think that's it.
All right. Beautiful. So first order is review of the minutes. First for the Pension Committee. We can get a
Steve Kirsch.
motion.
Yes, Steve Kirsch, I move to approve the minutes and voting record for the Pension Committee meeting of October 27th, 2022.
We have a second.
John Formicella, second.
Thank you. Any discussions, comments?
None
Okay,
in the
hearing
room.
none. None in the room, none on the phones. Any opposed? Hearing none, we will pass it. And then OPEB Board of Trustees.
I'll make a motion to approve the minutes.
Thank you, Ron. We have a second.
John Formicella, second.
Thank you. Any questions, comments? Hearing none, any opposed? We are unanimous. All right, first new business is setting the meeting schedule for 2023. So based on our quarterly, I was looking at 427, 727, 1026, and then 125, 2024.
Like just those are the dates, I came up with those same dates for, the fourth Thursday. of
Right.
each-
Each quarter, right? That's what I figured.
April 27th, July 27th, November 26th,
October
October 26th. And what was the January date?
25th.
2024.
2020.
Right.
So those are all Thursdays, Mike, at 6
Right,
p.m.,
6
correct?
p.m. Yep.
So I guess we need
We just need to follow the town clerk.
Do those need to be voted or is consensus among?
I mean,
Without objection.
Yeah. it's-
Right, without objection, I think it's a
I don't think
consensus.
it's that, yeah, that's fine.
Right. Perfect.
I'm just gonna object for the sport of it, that's all.
Nice. Thank you so much.
Wow, it's good.
He's feisty tonight. I love this.
Oh, I was just gonna say that, same word.
All right,
one way
now
to
we can have
describe
some
it, Mike.
fun and we can, Devin.
Okay, good to see you all. Would someone in the room be able to give me co-hosting capabilities so that I can share
I
this?
guess so, Devin, I guess
Thank
so.
you. Otherwise, I can just.
Otherwise,
let
it's
you
not gonna
stumble
be a
through
very
it.
good meeting.
That's fun.
You should have it.
All right, yep, perfect. Okie dokie, so hold on one sec, let me just make sure I can still see all your faces. So we now have the calendar year-end report. The first order of business is to go through the governance calendar. Actually, I guess I'll just give you a quick fiducian update, just so you're up to speed on everything. We do have the date and location of our conference this year. So this past year, we did 2 separate conferences, one in Connecticut, one in Chicago. We are going to be joining forces and doing one conference in Boston. So if you can make it and you're interested, we'd love to have you. You may have also seen a communication come out midday yesterday with some succession planning for the firm. So our CEO, Bob DeMeo, who is based in Chicago, is at some point over the course of this next year going to be moving into a more of a chairman role. And we have engaged a search firm and have an internal CEO search committee. I'm actually a part of that committee to identify a new CEO. So it's exciting and just standard succession planning. No one's really going anywhere. It's just kind of a reshuffling of responsibilities. So in case you noticed that communication, just didn't want to let it go unmentioned. So the first order of business tonight will be to go over the governance calendar. It's really a robust topic this quarter because what we have is our updated capital market assumptions, and we have some asset allocation modeling and some suggested portfolio changes. So that's what we'll tackle first, and it's going to be kind of a heavy lift. Once we get through that, everything else is gravy. We'll do a review of the capital markets, and then I'll go through performance of the 3 plans. So here on page 7, this just kind of sets the scene for what we expect from markets over the next year. And there are really 3 broad themes. The first is persistent volatility. We saw increased volatility last year. If you look at the number of trading days where the S&P traded either up or down more than 1 percentage point, we had 121 of those trading days last year. The typical average is 65, so almost twice as many days of high volatility last year. And, you know, we do expect that kind of environment to continue. So with an environment of heightened volatility, you typically see opportunities for diversified portfolios to add value. You typically see opportunities for active managers to outperform. So we actually think that increased volatility is likely to ultimately be a benefit to the way that the portfolio is invested. But you know, there were several years where we got used to very muted levels of volatility. So it's an adjustment for folks to get used to. The next big theme that we see in the markets over the next year is moderating inflation. We don't think that inflation will come all the way down to the Fed's 2% target, but we think it certainly, you know, we've already seen evidence that it has started to trend downward, and we think that it will continue, that downward trend will continue to accelerate. So if we had to wager a guess, probably by the end of the year, we'd be looking somewhere, you know, maybe 3.5% to 4%, and then sometime next year getting down to more long-term levels, 2.5% to 3% or so. So falling inflation is likely to be a tailwind for the markets. It's likely to result in positive reactions from investors and be good for companies. So it's likely to help prop up the markets a bit. And then finally, we do think that at some point in 2023, we will see the bottom of the bear market that we've been in and the beginning of the rebound. We're not going to say exactly when we think that'll happen, but really the writing is on the wall in terms of the fundamental factors that are going on in the market that would indicate that we're probably closer to the end of this bear market than we are to the beginning. So all that is what we expect in the near term. And what we think in terms of the way that our capital market assumptions have changed and what we are doing in client portfolios as a result of those changes is, first of all, again, we think diversification is going to be very helpful. So that's good. Like we've always had diversified portfolios and we're sticking with that approach. The next thing is that the fixed income environment is really different. You've seen yields jump substantially based on where they were at the beginning of 2022 and where they ended the year. The Fed is probably nearing the end of its rate hike campaign. Consensus seems to be that we expect another 50 basis point increase total. So probably another 25 at the next meeting and then 25 at the meeting after that. And then we're likely to see them pause in this rate hike campaign. And a lot of folks are actually even calling for interest rates to come back down at the end of the year. So the pain of going from point A of very low interest rates to point B of reasonable interest rates, that pain that's baked into the price return is largely behind us. And now what we're left with is actually positive real yields from fixed income. So it's a much more constructive fixed income environment than it was a year ago. So what we're doing in response is shifting out of the more defensive, kind of unconstrained fixed income mandates that were designed to help protect in a rising rate environment and shifting more heavily back into traditional fixed income. We've also been diversifying our fixed income exposures, adding exposures to TIPS, which we think are likely to perform well in the environment, and in some cases adding exposure to high yield as well. So those are some of the changes that we're seeing on the fixed income front. And then based on the pullback that we've seen in equity markets, we have been making just very modest shifts out of large cap equities and into small caps. And that's because of two reasons. One is that historically small caps have really performed very well coming out of a market bottom. So their recovery tends to be stronger than that of large caps. And the second thing is that they were more beaten down in 2022 than large caps were. So they saw some more downside, likely to see a higher bounce back as well. And then in terms of the shift between the breakdown between domestic and international, we still are very constructive on international markets. And if you look at our capital market assumptions, our return expectations for international equities are higher than our return expectations for US equities. That being said, we also acknowledge that there are increased risks that come with the international markets, not the least of which is the ongoing war in Eastern Europe. So we are not proponents of a substantial overweight to international. So in many cases, we're doing a slight shift in our client portfolios to make sure that we're just kind of in line with the neutral market opportunity set and that we don't have a pronounced overweight to international relative to that global opportunity set. And then we think that, real assets continuing to have that diversifying exposure is still important and still a justifiable portfolio position. So here on page 9, you'll see what our capital market return assumptions are. So our most recent return assumptions are shown here in this 2023 column. And then just for comparative purposes, we've shown what those assumptions were at the beginning of last year and the year-over-year change. So you can see that really the most substantial change is up here in the fixed income arena, where you see our bond return assumption jumping from only 2.4 last year when you factor in inflation, that's basically a zero return expectation for US bonds. Now that return expectation is 5%. So really a much more robust return expectation within the fixed income market. And then, you know, broadly speaking, really every area of fixed income, we're seeing increased return assumptions. So that bodes well for fixed income investors.
Kevin, quick question.
Sure.
You show the expectations 22 and 23. How did you match up against those 22 expectations over the course of the year?
It's not easy to make the direct comparison. So you'll see that these are our 20-year outlooks. So we won't know until we are in 2042 to see how well we did on that 20-year expectation. We have done that analysis for our prior capital market assumptions. We build assumptions on both a 10-year and a 20-year basis each year. We always show our municipal clients a 20-year forecast because the actuaries are using very long-term return assumptions. So we didn't have an expectation that bonds would return 2.4% in one calendar year. Our long-term outlook when we started last year was 2.4%. Now, from a starting point of where yields are in 2023, our long-term outlook has increased to 5%. So we can't really give ourselves a report card based on what our assumptions were last year. But when we do look back historically, we've been pretty close. You know, the only guarantee is that we're not going to be spot on with any of these numbers. But historically, we have been in the ballpark for our 10-year and 20-year assumptions.
So the trend was close.
Yeah. Yep.
Okay.
It's a very good
Thank you.
question, though. Sure.
Kevin?
Yep.
I have a question as well. To kind of go back to the 2023 themes, you know, with the announced layoffs that are happening in the tech industry and also in the financial, you know, with those things happening, sometimes that's a ripple effect. So you don't have anything mentioned about recession or anything along those lines? I'm not, you know, I don't know what your thoughts are.
Yeah, happy to talk about that. So we do have some comments on recession in the capital markets review. Recessions are part of normal economic cycles. So when we factor in our 20-year outlook, you know, generally speaking, we have a recession every 6.5 years. So with our 20-year outlook, there's kind of always the expectation of a recession baked in. So if we're talking about just our economic expectations for the coming year and a half or so, I think that it's fairly likely that we will enter into a recession at some point this year. We don't think that it will be a very deep or prolonged recession. We've started to see, as you said, we've seen layoffs in the tech industry, we've seen layoffs in the financial industry. Other areas of the job market are still very tight, and the overall unemployment rate is still very low. We do expect that as companies continue to face these inflationary pressures and we see higher interest rates, which is difficult for companies to weather, we do think that ultimately that will trickle into other areas of the labor market. It's kind of interesting to read the headlines, because I would say that going into the fourth quarter of last year, basically everyone was saying we're on the precipice of a recession. There's no way that the Fed will be able to navigate a soft landing. And now everything that I've heard and read seems to be kind of a 50-50 split. About half of the outlooks that I've read have said, we think the Fed might be able to do it and might be able to avoid a recession and get us that soft landing that they were looking for. And then the other half are saying that they expect a recession. I have not heard any outlook that is calling for a very deep and painful recession. So kind of consensus is, it seems maybe likely, but it's not going to be that bad.
Thank
Does
you.
that help answer the question?
Yep, thank you.
Okay, you're welcome. So if we look here at the equity return expectations for US all cap, we're calling for about the same return expectation that we had going into last year, a 6.7% annualized return. You'll see, as I mentioned, that the return expectations for international markets are much higher, but again, those come with elevated risk. So we don't really want to have a pronounced overweight to international, but we do think that having a significant amount of exposure is justifiable. And then finally, down here, the category that matters to you is broad real assets. You do have a strategy in your portfolio that has a broad real asset mandate, and we've seen a jump in the return expectations for that as well. And we like to see continued exposure. So all that being said, page 11 shows the output of, this is called our Frontier Engineer system. It's our proprietary asset allocation modeling software. So what we do is we input all of these capital market assumptions and we run various portfolios and then model out what we expect the return and the risk profile to be. So what you'll see here on the top, and we don't need to get into the details, we actually have a much more simplistic page, which captures our recommendations on the following page. But what this shows is this blue line represents the current portfolio targets. And then the line right below it represents the portfolio that we are proposing with the underlying tweaks that I talked about. So the change in the makeup of the fixed income, a little bit of a proportional overweight to small cap versus large cap, shifting slightly the domestic and international components. So you'll see it doesn't really change the return expectation. The return expectation for the current portfolio and for the portfolio with those tweaks that I mentioned is 8%, with volatility about 13.5%. So the changes that we're calling for don't really result in a vastly different return and risk profile, but we think that the changes will take advantage of the current market environment. So some of them are more tactical in nature rather than really long-term and strategic, but still will help you meet your return objectives. So if we bring all of this back to the return assumption that the folks at Hooker and Holcomb are using, that return assumption is 6.75%. And you can see that our expectation is that this portfolio will return 8%. So we think that we're going to be able to help you achieve your return assumption. Now, some people might see this and say, well, that's way above our 6.5% return assumption. Why don't we dial back the risk really significantly? And then, we can still meet that 6.75%. If you look back on what's transpired over the last 5 years or so, you haven't met that objective. So we still have a bit of ground to make up for what has been kind of a choppy market environment. So we would not advocate for substantially shifting the allocation profile to make the portfolio much more conservative, if that makes sense to folks. So any questions about this before I get to this page? I really do think that this page 12 is much more helpful, but I'm certainly happy to answer any questions about the Frontier Engineer if you'd like.
Just one nitpicky thing that is here. For the future, can you make the blue lighter so the black really jumps out?
Oh, so the black shows up? Okay, I'll give that feedback.
Or do put in white, or do the lettering in white.
I'm holding up
All right.
the light.
That's a fair comment. It's so funny. We get index returns sent around to the firm on a daily basis. So that comes to my inbox every morning, and the numbers that are negative are in red, and I can't ever I used to be able to read them, and now the older I get, I'm like, I can't read that number. And I've thought about asking them to change the font color, but I'm too proud. I'll just continue to squint through it.
Fancy way to brackets anymore.
No.
Okay, so page 12 are the portfolio changes that we are recommending. So you can see that broadly speaking, we're not significantly shifting the overall allocation profile. So the fixed income remains the same at a 25% target. we would be increasing domestic equity by 2 percentage points and increasing international equity by 50 basis points. So on a proportional basis, the domestic equity exposure goes up a little bit, and then we'd be bringing real assets down to 5% rather than 7.5%. So not a huge shift in terms of broad allocation, but some pretty substantial shifts underneath the hood. So if you look at fixed income, I mentioned we have been adding exposure to TIPS in a lot of client portfolios. So we have a 1.5% target allocation. That would be a new fund in the portfolio. Then we would be increasing the exposure to the 2 traditional fixed income managers, Baird and MetWest. Again, with higher interest rates, more traditional fixed income strategies are likely to perform better. Whereas leading into 2022, we wanted a more defensive profile with a lot of exposure to the BlackRock fund. So we do bring down the BlackRock fund by 4 percentage points down to a 5% target. And then finally, the last thing that we'd like to do is swap out of PGIM Global Total Return and replace it with a new global bond manager. And I do have a manager search and a recommendation right behind this page. So, and we'd be reducing the overall global bond exposure by 50 basis points. So a bit of shuffling under the hood, but ultimately our fixed income exposure still stays at 25%. Then within domestic equity, we'd be bringing up the S&P exposure by 1 percentage point, but we'd also be bringing the small and mid cap exposure up by 1 full percentage point. So proportionally, the small and mid cap exposure becomes a larger piece of the domestic equity allocation. So just a modest tilt in favor of small and mid cap. And then on the international equity side, again, just a slight increase in the emerging markets exposure. Oops, sorry about that. But the developed markets managers would stay the same. And so if we look at that, if we compare the equity exposure previously, we were at 39% domestic, 28.5% to international. With this shift to 41% domestic and 29% international, we have a little bit heavier allocation to domestic on a relative basis. And then bringing that principal diversified real asset fund down to 5%. So I'll take a pause there before I get into the global bond search. Does anyone have any questions or comments about the recommended allocation shifts?
Just a question on your small cap. Is that mainly Russell oriented accounts?
They are compared to the Russell 2000 indices. So Hotchkiss and Wiley is a Russell 2000 value and Conestoga is a Russell 2000 growth as their stated benchmark. Both of them, Hotchkiss and Wiley has more of a micro cap tilt and a pretty deep value bias. And Conestoga has a bit more of a conservative growth approach. So both of them will look different from the benchmark and are not afraid to deviate from the benchmark. So although, yes, they are compared to the Russell 2000 indices when we show relative performance, there's likely to be a significant amount of standard deviation compared to those benchmarks simply because they're very active managers. They're not benchmark replicators.
Thank you.
Sure. Any other questions? Okay, so maybe I'll quickly go through the global bond search, make my recommendation, and then we can flip back to this page and vote on it if folks are okay with that.
Sounds good.
Great. So we have shown 3 strategies in this global bond search. So the PGIM Global Total Return Fund is the fund that we are recommending getting rid of. You'll see here on page 15 that this is listed as being on watch status. It actually just moved to a terminate status. So, you know, we were right in recommending a replacement. There's been a lot of changes organizationally. They brought in the co-CIO of the firm to serve as the lead portfolio manager with veto power. It was seen as kind of like a, hey, you guys aren't doing your job, we're going to bring in the big guns to monitor you. It was seen as that kind of a move. And since then, they've also had a couple other management changes. So a lot of shifting organizationally, and the performance has been very weak. So that's why we're moving away from PGIM. The three funds that we have brought for your consideration are Brandywine, Dodge & Cox, and Hartford World Bond, which is sub-advised by Wellington. Brandywine may sound familiar to you because you used to have that fund in your portfolio. Brandywine is kind of similar to PGIM in that they are pretty volatile. They tend to be concentrated in only about 8 countries. And so if those bets don't work out, they tend to underperform relative to the benchmark. The fund that I think is the most appropriate for your portfolio is the Dodge & Cox fund. So if we look at page 16, you can see some of the performance metrics. I know this is a very busy page. It's kind of hard to see what's going on. Basically, anytime you see something in green, that means it's good. It was the best performer out of the 4 funds that we're showing. The orange is not so good. So you can see PGIM in terms of annualized returns has produced the weakest over the past 7 years, whereas Dodge & Cox is pretty much the standout performer. But what I think is more important is that the volatility of Dodge & Cox is much lower than what you have experienced with PGIM or what you would experience with Brandywine. So you can see this red represents Brandywine. As I mentioned, it's pretty significantly concentrated from a country perspective. So I don't know that that's the best profile for your portfolio. So Dodge & Cox has a more palatable volatility. So, you know, highest alpha out of the solutions, it has the lowest expenses and volatility somewhere in the middle. So for those reasons, we think that Dodge & Cox is the best fit, but certainly happy to answer questions, entertain objections or other thoughts. One thing that I will mention is that Dodge & Cox is actually moving to a discuss status, and that is simply because one of the members of the investment committee, it's not the lead portfolio manager, but one of the members of the IC is retiring at the end of this year. It's been very well telegraphed. There's a succession plan in place. It's not going to upset the apple cart, but when there is an organizational change like that, we tend to just keep a closer eye. So if you do add this to the portfolio, in next quarter's report, you might see a discuss status and then say, oh my gosh, we just added that and the fund's already on discuss. It's not something that we're concerned about. It's just kind of part of our process. So any questions, any objections to the Dodge & Cox, or do you think that's a good solution for the portfolio?
Dodge & Cox is a well-respected name.
Yeah.
Yep.
Very comfortable with it.
Okay, great. So I will go back and pull page 12 back up, and we can have any further discussion or take a vote.
Yeah, so we want to make a motion to approve?
We can make one motion for both.
Right.
We need to go independently.
Be for pension and for OPEB, they should be separate.
Actually, this is just.
This is just pension.
This is just pension.
It's just pension, right?
Just the pension. Yep.
A second.
A second.
All right. Any discussion? Any objections?
So again, you're approving that with Dodge &
The
Cox
allocation, correct.
Dodge & Cox and the allocation.
and the allocation.
Any objections?
None here.
Hearing none? Hearing none, we're approved. Very good. Thanks, gentlemen.
Great.
Excellent.
So I told you that the GovCal section would be a heavy lift. We're pretty much done now. We do have a snapshot of the most recent Val report that we have on file. We've spoken with Hooker and Holcomb. I guess they're still waiting for some data points, so they haven't release the 2022 numbers. But again, the actuarial return assumption is 6.75. And you do see between 2020 and 2021, pretty significant jump in funded status for both of the plans. Unfortunately, you're probably going to see that go back down when we see the 2022 Val report, but you're still in much better shape than many of your peers in the municipal space. And then page 20 just shows a snapshot of the OPEB plan, a little bit of a lower return assumption at 6.5% for that. Okay, so I've been talking for a long time. Any questions before we talk about the capital markets? All righty.
We're good.
Let me bring this back up. So to the earlier question about recession, these are kind of the area of the report that you will see comments about the overall economy and the markets and that sort of thing. I already hit on our themes for the market for the next year or so. And I already talked about the additional volatility that we've seen. Again, 121 days last year where the market moved by more than 1 percentage point. And it was the only year on record where both the S&P and the Barclays aggregate were down. And not only were they were negative by a lot. So the Bloomberg Barclays aggregate index was down 13% and the S&P was down 18% last year. And that's even when you factor in the positive returns that we saw in the fourth quarter. So there was really nowhere for investors to hide. Pretty much everything with the exception of commodities was negative last year, which you can see here on page 24. So page 24, the bubbles represent the return for the quarter, and then the bar represents the return for the calendar year. So again, negative across the board with the lone exception of commodities, which were up. The reason that commodities were up was largely due to energy, thanks to the war in Eastern Europe. So we did see positive momentum in the fourth quarter with most areas of the market having positive returns, but still not enough to chip away at the deterioration that we saw over the course of the calendar year. I'm going to go back one page. And as I mentioned, we still see a strong labor market. So unemployment rate still down below 4%. We do think that that will begin to creep up, but we still think that even if we enter into a recession, it's not likely to be one where we see 10% unemployment. It's probably going to still be a relatively strong labor market. We have seen evidence, as I already talked about, of inflation kind of rolling over. And one of the things that is the biggest components of CPI is something called owner's equivalent rent, or OER. And that's the way that shelter is captured within CPI readings. The way that OER is calculated is very much a lagging data point. So we've already seen housing prices come down, and we've seen kind of a slowdown in new construction, and we've already seen all of that evidence, but it hasn't trickled into that OER number yet, and it will. So when we see the rental prices that are captured within owner's equivalent rent, when we see those come down, I think that inflation will be coming down even more swiftly than what we've already seen so far. So you can see here, this blue line represents the home price index, and we've already seen that turn over, but this owner's equivalent rent line hasn't caught up yet. So that's still moving up. At some point in time, probably pretty soon, we're going to see that shift downward. And that number is about 30% of the CPI reading. So once we see a shift in OER, we're likely to see that CPI number come down even more substantially. let's see, I will say in terms of valuations, we still are either at or below long-term averages. So US markets look like they're trading about fair value, about in line with their long-term averages, whereas international developed and emerging markets are trading a bit below average. So that's good. It means that there's some room to grow within the equity markets. And then, of course, the importance of diversification in the quilt chart. The orange box represents a balanced portfolio with lots of exposure to different asset classes. And you can see it's never been the best performer in any one calendar year, but it's also never been the worst. So part of the way that you make money is to not lose as much money. So certainly 2022 was a difficult year, even for a balanced portfolio, was down about 15 percentage points. Commodities, again, the only thing that were positive, everything else negative. But in the long run, over the last 10 years, a balanced portfolio has served investors well. So I'll take a pause. I actually just got a little pop-up that my internet connection is unstable. Can everyone still hear me okay?
Yep.
Yes.
So far, so good.
Okay, excellent. Any questions on capital markets before we look at the portfolio? All righty. Okay, so relative portfolio performance has been challenging. So we can see for the quarter and the fiscal year to date, which is a 6-month period, and then the 1 year, we are behind the benchmark. And that's been because of some of the managers that I'll talk about when we get further into the report. In absolute terms, the fourth quarter was a good quarter. So the portfolio was up 7.8%. But still, when we look on a longer term basis, that 5-year number and then that inception number, going back to 2015, we have not met the return objective of 6.75%. So that's why we think that the updated capital market assumptions, which are higher, the portfolio's expected return of somewhere in the neighborhood of 8%, is likely to help make up some of that ground that's been lost in terms of the performance relative to the actuarial return assumption. You can see that for the most part, you are in line with your target allocation. The asset allocation versus the target is shown on the bottom right-hand side. And we generally use the quarterly cash raises for pension payments as an opportunity to rebalance the portfolio. So when we raise cash for outgoing distributions, we'll take we will sell out of the funds that are the most overweight. And that kind of helps bring the portfolio back into balance. So that's something that's taking place on an ongoing basis. This page just shows the allocation again, but we do share what the maximum and minimum thresholds are that are stated within the investment policy statement. So if you ever want confirmation that your asset allocation profile is within the guidelines that are stated in the IPS, this is the page where you can find it. That's something that we pay attention to. We wouldn't ever let it get out of compliance with the IPS. So you're in good shape on that front. And then here on page 33, we just have a snapshot of the managers in the portfolio. So again, we are going to be replacing PGIM with the Dodge & Cox Fund. So I think that'll be a good shift for the portfolio. The only other strategy that is that has a status other than maintain is the BlackRock Strategic Income Opportunities Fund. That's not something that we are concerned about. One of the PMs on the fund, Bob Miller, he's not the lead PM, is planning on retiring at the end of this quarter. So that's been in the cards for a long time. Didn't come as a surprise. They've got a succession plan. Shouldn't disrupt anything, but we'll keep an eye on that transition. And
Devin, I have a question.
Sure.
If I'm looking at the chart on page 32.
Okay.
What we're looking at there is that the percentages of our portfolio that's in each group?
Correct.
Well, I'm looking at international equity, right? And I see 28%. and I go back to the chart on page 9, which was our portfolio allocation. And if I look at emerging markets and the international developed equity, that only comes out to 19.7%. Am I reading something wrong here, interpreting something wrong?
I think so. So when you say, did you say page 9?
Page 9, which is the,
This page that I have up on the screen?
yeah. Oh, I'm sorry. No, that's the returns. I'm sorry. That's not the percentage of
Correct.
allocation. Sorry
Correct.
about that.
No,
Okay.
that's okay. Nope.
Okay, I got it.
Glad you asked the question. I'm used to looking at these things all day, every day. So
Yeah.
you see them once a quarter at the most.
Yeah, no, sorry about that.
No, that's okay. Yeah, so this page does represent, so the target to fixed income is 25%. Your portfolio at the end of the year was at 24.9, and so on and so forth.
Right.
Yep. Okay, so as I mentioned, no other managers are on watch or terminate status. We're comfortable with everything in the portfolio. But again, we have seen some relative performance struggles. So let me talk a little bit about that on pages 36 through 38. So the way to read this report, just as a refresher, these blue, the darker blue lines, which do have the white font to allow you to read the numbers, represent the composite results for that particular segment of the portfolio. So this fixed income number that you see here, collectively, your fixed income managers were up 2.2% in the fourth quarter. For the fiscal year to date, they were down 1.8%, and on a one-year basis, they were down 11.7%. Right below that, we have the benchmark. So the benchmark was down 14.5%. So although down 11.7 is pretty awful for fixed income, which you think of as, you know, kind of the safety net in a portfolio, compared to the broader markets, the broad benchmark, your managers collectively helped provide a bit of protection. And that was a result of the exposure to the BlackRock fund. So as I mentioned, the BlackRock fund is a more defensive strategy. So we had a significant allocation to that, knowing that or not knowing, but expecting that the Fed would be raising interest rates. So that more defensive play helped protect in that rising interest rate environment. Now that we're in an environment of higher rates with just maybe a couple modest rate increases left, we think that the strategies like MetWest and Baird are likely to outperform on a go-forward basis. So in the long run, you know, your fixed income managers have added value, but disappointing, certainly, absolute returns over the past year. And then PGIM, you can see the performance struggles. And again, that's something that we're getting rid of from the portfolio. On the domestic equity side, you can see if we focus on the one-year number, you can see some modest underperformance compared to the benchmark. So collectively, the managers are down 19.2%, whereas the benchmark is down 18.2%. We've got passive exposure in the large cap space. So this fund is always going to track the return of the S&P 500. But we've got active management in this mid cap space. So Diamond Hill is the more value focused manager. And then Conestoga is the more growth focused. So you can see just the very the magnitude of the negative performance is really stark, the difference between value and growth. So last year, growth had been leading markets, and then growth became out of favor last year. So you saw relative outperformance from value strategies. So the Diamond Hill strategy held up a little bit better in last year's environment. Conestoga was weaker due to the fact that it's a growth strategy. And then you also saw some relative weakness compared to the benchmark from Conestoga. That's due to a couple different factors. One is that they were underweight the biotech industry, which performed very well. So some of their peers that had exposure to biotech performed better. They also have zero exposure to energy. And just broadly speaking, they tend to be a more conservative growth strategy. And so with that more conservative profile, it was the more aggressive growth companies that performed a bit better last year. Longer term, we have no concerns about their performance. You can see they're in the top third of the peer group on a 5-year basis, and they're well ahead of the benchmark. It's a pretty concentrated portfolio, so it's likely to have periods of relative volatility compared to the benchmark, but still, it actually is our highest conviction small cap growth manager. So the analyst that covers that space likes Conestoga better than all of our other small cap growth managers. On the international equity side, we also have some relative underperformance, and that comes all from Harding Loevner. We have spent multiple quarters talking about Harding Loevner. Actually, if you look at their fourth quarter and fiscal year to date, so the past 6 months, their performance is right about in the top third of the peer group, and they're substantially ahead of the benchmark. So we've seen a little bit of a turnaround from Harding Loevner. The longer term results have still been impacted. They had a really tough 2020. And then in the beginning part of 2022, they struggled. So again, they have a growth bias. Growth names did not perform as well as value names in 2022. And they also did start off the year with some exposure to Russia and the Ukraine. So they had about 4 holdings in the portfolio that were essentially marched down to 0 at the beginning of 2022. So that's why you see that longer term performance struggle, but they have started to outperform over the course of the past 6 months. And then finally, we've got the principal diversified real asset fund compared to the broad equity markets and actually compared to the fixed income markets as well. Certainly a better performer. So down, but only down 6.1%, whereas international equities down 18, domestic equities down 19, fixed income down almost 12. So that provided a bit of relative protection. We've talked about the principal fund before, so it has exposure to natural resource equities, commodities, infrastructure, TIPS, REITs, really everywhere within the real asset marketplace. So a little bit of relative underperformance over the past year, but stronger results on a longer term basis. So I'll take a pause there before we look at the OPEB portfolio. Any questions or concerns about any of the managers or the allocations in the pension portfolios?
No.
Okay. Great. So let me zip ahead. We do have 2 sections in the report. One, the first is the town pension, and then the second is the Board of Ed pension. They have the same performance because they have the same underlying managers, and they are right around the same asset value. So this is the Board of Ed. We ended the quarter with 13.1 million. That's shown on page 45. If we go back to the town plan, 13.1 million also for that one. So very close in terms of assets and allocation. So the OPEB section starts on page 57. 58 shows the performance. This is an all passive portfolio. So over the long run, you're likely to see performance right about in line with the benchmark, which is what you have seen. So on a 1-year basis, down 17%, which doesn't feel great, but right in line with the benchmark. And then on a 3-year annualized basis, up 1.8%. And then going back to the inception in 2018, up 4.1% per year. You do tend to see a little bit of deviation compared to the benchmark on a shorter term basis. And that's because of a couple different things. One is when the OPEB, when the contribution gets made to the OPEB each year, we generally dollar cost average that into the market. So sometimes there is the impact of holding that cash can create a difference between the portfolio's performance and the benchmark performance. And also the international fund, even though everything that we have is passive, when you have an international equity strategy, or an ETF, that's an international strategy, the timing of the international market open and close is different from the US. So that can result, you can see when you look at the performance results for the international, the passive fund, that that one tends to deviate from the benchmark a little bit more, just because of the nature of that market. But again, all passive, and pretty much the same allocation as the pension portfolios, a little bit more in fixed income. Again, we have a more conservative return expectation of 6.5% for this portfolio. So, you look at the results and they're right about in line with the respective benchmarks, which is exactly what we would expect. So I'll take a pause. Any questions about the OPEB plan? Okay, that is it for me. I'm certainly happy to. I'm looking at the clock at 6:55. You probably don't want me talking any longer, but I'm happy to do so if you have remaining questions.
Good. I don't have anything else. Anybody else?
Nope.
Nope.
We're good.
All right. Kevin, thank you very much as usual.
Thank you. Great to see you all. And hopefully I'll have more good news next quarter. Fingers crossed.
Really?
Fingers crossed.
All right.
Thanks, everyone.
Pretty considered on the tips.
Adjourning, Mike?
Yeah, we can adjourn. Make a
Steve
motion.
Kirsch, motion to adjourn.
Very good. Thank you.